Well, good morning, everyone, and thank you for being here so early in the morning. This is discipline, and especially for a subject which seems so peripherally related to finance, which is central bank balance sheets. Now, why this talk? Well, in the last few years, certainly since the global financial crisis, we've seen a huge expansion in central bank balance sheets. I think if you look at the Fed's balance sheet, it's gone up from maybe less than 100 billion in reserves. That's the liabilities of the central bank held by banks, to at one point over 4 trillion during the pandemic. And of course, the aggregate central bank balance sheet had gone up to somewhere near 8 trillion. And you would think that when the central bank balance sheet expands, it's putting out as a central bank liability one of the most liquid assets on the planet. In fact, it's more liquid than cash because you can transfer it more readily. Central bank reserves are final settlement. You can transfer it more readily than cash in large amounts. And you would think that would liquefy conditions in financial markets. Yet any time this central bank balance sheet is being sought to be withdrawn and shrunk, you see conditions tighten up in financial markets. And the question is, where did all the liquidity go? So, for example, after a phase of quantitative tightening, we saw spikes in the repo rate in September 2019. And then when after that, the Fed went back in to supply reserves to the banks. And then in March 2020, you saw almost every parameter of liquidity screaming red. We need more liquidity. Everything sort of started spewing out. And this was the dash for cash in March 2020, when the Fed came in again and expanded its balance sheet hugely this time. In the UK, you had the beginnings of quantitative tightening, but you had turmoil in September, October 2022, no doubt fueled by actions by the then government, the short-lived government of Liz Truss. But it did suggest that liquidity conditions were fragile. The Bank of England came back for a while to supply liquidity to the market. And of course, in March 2023, we had the failure of Silicon Valley Bank and others. And what many people don't realize is the extent of intervention by the Fed and the Treasury in the financial markets again. For instance, implicitly, all uninsured deposits were insured in March 2023 by the statements by the Fed and the Treasury. That's huge. That's unprecedented. Maybe you have to go back to the global financial crisis. But that's a massive intervention in financial markets, coupled with almost $1 trillion of lending by the federal home loan banks at that time. So you supply enough liquidity, supply enough implicit capital via these guarantees, and no doubt you cool down the system. But why did the system get so fragile in the first place? So what we want to ask is, are there connections between the expansion of the central bank balance sheet, then its subsequent contraction, and financial fragility? So what I want to talk about here is basically focus on the liability side of the banking sector, and basically argue that when you look at the liability side of the banking sector, there's a counterpart expansion to the Fed's balance sheet expansion. And if you ignore this, you ignore the mounting claims on liquidity that the commercial banking sector is issuing, even as the central bank balance sheet expands. As one example, reserves that the Fed puts out, they're a liability of the central bank, but they're held by commercial banks. And commercial banks finance these reserves not with long-term money like capital, nor even medium-term money like term deposits. In fact, every dollar of reserves, as I will show, is financed by $1.3 of demand deposits. And of the demand deposits, these are typically uninsured demand deposits. So yes, you have liquid assets coming onto bank balance sheets, but you have very demandable liabilities also coming. So QE, quantitative easing, where the central bank expands its balance sheet, is typically also an expansion of commercial bank balance sheets. However, quantitative tightening, which is the process by which the central bank shrinks its balance sheet by selling securities back to the market, is not the reversal of QE as far as commercial banks go. One, you see those liabilities that were issued by the commercial banks don't shrink as fast. In fact, they stay pretty high. And second, you see that within the banking system, the risks migrate to the small and medium banks that are least able to bear it. So in a sense, quantitative tightening is not the reversal of quantitative easing. It's not as, Janet Yellen famously remarked after basically echoing Pat Harker, it's as boring as watching paint dry. It's not boring at all because the system has become much more fragile at that point, and I'll show you that. And basically, it's the least capitalized banks that take liquidity risk to boost return on equity, but become fragile in the process. Okay, so let me tell you a little bit about balance sheets for a second, and I'll tell you why the facts I'm going to present are not that obvious, are interesting. Just in terms of the background for this paper, this is with Viral Acharya, Sasha Steffens, and Rahul Chauhan, who's a PhD student at Chicago. And first, Viral and I wrote a theory paper. We were trying to understand why activity wasn't progressing despite everything that the central banks were throwing against it with various forms of unconventional monetary policy. So we wrote a paper saying this is what should happen. So that was our theory. And then we said, let's go look at the data. And for once, the data sort of cooperated with the theory, and it looked like what we said in the theory was actually showing up in the data. And that's this paper. So here are two ways that the central bank can purchase assets from the banking system. On the top, we have the Federal Reserve. Let it start with some Treasury securities, and the liabilities of the Fed are reserves held by the banks and cash. The Fed also has some equity, which nobody really seems to care about. So that's the asset and liability of the central bank. Let's say it buys one Treasury security from the bank. Okay, if it buys one security from the bank, its assets go up by one, its reserves go up by one because it has issued the reserve as a promise to pay to the commercial bank, and the cash remains the same. From the bank's side, their Treasury securities and reserves at the Fed to begin with, those Treasury securities go down by one because it's sold to the Fed, and its reserves go up by one because it has a reserve claim. So in this asset swap, essentially the bank is swapping a long-term secure treasury with the Fed in return for reserves. The bank's balance sheet is becoming more liquid. Okay, long-winded way of saying how it can happen when you buy from the banks. Turns out this is not the way quantitative easing seems to work. Instead, it works through the Fed buying from the other entities like pension funds. So let me introduce a third entity, which I'll call the public, which is the pension fund. And we've seen the Fed, what it does. We've seen its balance sheet. The Fed is buying from the public. So the Fed is essentially buying from the pension fund. The pension fund's Treasury securities go down by one. Now, if it did exactly the same thing with the pension fund should hold reserves, but the pension fund cannot hold reserves. The only entity in the system that can hold reserves, there's a caveat I'll come to a little later, but is the bank. So the pension fund takes the reserves or the claims on reserves the Fed has given it in exchange for the sale of its security, goes and deposits it in its bank. So what the pension fund has is a deposit, and what the bank has is now a deposit as a liability and reserves at the Fed. So as the Fed has expanded its balance sheet, the commercial bank has expanded its balance sheet. This is how quantitative easing seems to work. The Fed expands its balance sheet, the commercial banks expand their balance sheet. But actually it works even more than this, because the commercial bank can always rebalance after it has accepted the reserves from the Fed and has more deposits. It turns out what it does is it runs down its time deposits, increases its demand deposits, and also issues lines of credit. All that happens on the back of the reserves it has. And that seems reasonable, right? I have this really liquid asset sitting on my balance sheet. It earns very little. It earns basically the interest on reserves. Why don't I use it by taking more liquidity risk and issuing really demandable claims against it? Those are cheap relative to something which requires me to lock in a term, which is costlier because I'm getting essentially liquidity insurance on the purchases of that security. So I issue uninsured demand deposits, which are the cheapest form of my financing. But I also have spare liquidity. The demand deposits aren't going to come for their money all the time. So I issue lines of credit. And since I don't need all this liquidity, I also run down my time deposits. And we'll see that's what happens in the process of quantitative easing. So what we want to do is look at all this. Let me skip past this because I've just told you all this. And we want to see what this means for the balance sheet. What we see is reserves expand, demand deposits expand, and there's a shrinkage of deposit maturity as well as writing lines of credit when the Fed expands its balance sheet. It turns out when the Fed contracts its balance sheet, that first chart I showed you, that's what happens. It seems to be more an asset swap with the banking system. The banking system's liabilities don't change. In other words, the banking system is giving back is buying securities from the Fed, giving back reserves, but its liabilities seem unchanged. And we'll come to why that might be the case a little later. But so you expand in one way where the banking system's balance sheet expands along with the Fed during the process of quantitative easing. But in the process of quantitative tightening, the Fed's balance sheet decreases, the banking system's doesn't. Put differently, in the process of quantitative tightening, what you have is an even more fractional reserve system, a smaller quantity of reserves supporting large quantities of immediately claimable sort of liabilities issued by the banking system. That then gives you an inkling, well, maybe the system then on the reverse gets more and more tight in terms of liquidity because lots more claims, but the underlying final settlement, which is through reserves, gets smaller and smaller at that time. Okay? And that's where we're going. We're going to show you that quantitative tightening means no shrinkage of these liquidity claims, and that suggests there's more financial fragility at the aggregate, but even in the small, we see some sections of the banking system have more problems. And this is also, if you think about it, something natural, right? When the system is oversupplied with liquid assets, nobody really cares. Everybody's willing to trade them. When the system becomes undersupplied with liquid assets, and if one part of the system wants it, the other part of the system is a little reluctant. If I give up my liquid assets, will I have enough when the time comes? So all sorts of new phenomena like liquidity hoarding, etc., show up, which is why the private system doesn't seem to intermediate the liquidity anymore when the system shrinks the available liquidity. Instead, you need things like the Federal Home Loan Banks to come in and intermediate the liquidity because there's too little of it for the private system. So even a small reduction in liquidity can make the system very, very tight. In other words, there's a ratcheting effect in terms of liquidity. The system becomes much more dependent on liquidity when the central bank expands its balance sheet. Is this always the case? Is this going to be the case for a long time? Obviously, we don't have enough data right now to tell, but certainly we've seen in the last episode, this seems to be what's happening. So here are some data to make the case. What you have on this graph is central bank reserves, okay? And what you see, those three peaks earlier are really the process of QE1, QE2, and QE3. The peak is where it sort of ends, and then we have a line where the next phase starts, and then another line where the third phase starts. So by 2014, the Fed is basically done with the initial phases of QE after the global financial crisis. There were three such phases. Then there's a period of drift, the post-QE period, when the Fed's reserves come down, but not sharply. Then there's a process of quantitative tightening when it brings down reserves sharply. And then in 2019, September, things get really tight. Spreads blow out in the financial market. Repo rates go through the roof. The Fed New York comes back in to buy securities and issue reserves. And what you see there, that initial kink upwards from September is quantitative easing resuming again. Then we have March 2023 when, the bottom falls out and the Fed comes back with both guns blazing and infuses a tremendous amount of liquidity into the markets. That's that steep uprise to about 17-18% of GDP. And then again, in 2022, first quarter, we see quantitative tightening starting again as the Fed wants to raise interest rates and ends quantitative easing. Okay, so that's what's going on with reserves. The green line here now is deposits. And as you see, there's a steady increase in deposits over time of the commercial banking system, similar to the increase in reserves. What is interesting is reserves come down, deposits don't, they keep going up, which is why some people say, well, maybe something else is going on. This is really about, households getting wealthy or something like that. That's Annette Wissing-Jorgensen and Lopez Salido's argument. But what you see is a steady increase in deposits. What we will argue is uninsured demand deposits go the same way. And uninsured demand deposits typically not held by households. They're the stuff that larger entities typically hold. So the third thing I want to show you is credit lines. Credit lines, what you see again is these are undrawn credit lines. So you see during the global financial crisis, it's coming down because people are drawing on their credit lines. And then what you see is a steady movement upwards again in credit lines. So if I have liquid assets, I write credit lines against them in the same way as I issue uninsured demand deposits against them, and I draw down my time deposits. And that's that last graph. The dark line, the too many lines here, but the light line is the reserves, which I've showed you before. The dark line up there, which is going up to about 40% of GDP, is essentially uninsured demand deposits. And you see a huge increase from about 10% to 40%. That's a tremendous increase in uninsured demand deposits. What you see on the time deposits is the dashed line below. There are two lines. One is insured, one is uninsured. You see the time deposits are coming down. So you have a commercial banking system which not only is issuing lines of credit, running down its demand deposits, but also, running up its demand deposits, especially of the uninsured variety. Now, when you start thinking of Silicon Valley Bank, you start getting the sense, why did they have 97% of their deposits uninsured? Well, they're just an extreme outlier on a broader phenomenon that was going on in the banking system, many more uninsured demand deposits in the system. Okay, so that's the aggregate. I'm going to show you, this is just a preview of what I'm going to show you. I'm going to show you that when you have these higher reserves, you have more demandable claims. I'm also going to show you at the aggregate level that when you have more reserves, you see the natural consequences to the pricing of claims. More reserves reduces the price of liquidity. More claims increase the price of liquidity, and you'll see both effects. And then I'm going to show you some panel tests across banks. One of the things with aggregate data is it's not clear what else is happening at the same time. So we'll show you panel tests across banks correcting for the time series and showing you that across banks, banks with more reserves tend to issue more demand deposits, tend to push down the price of time deposits. So in a sense, they're trying to get rid of their time deposits. And finally, I want to end by showing you financial fragility measures and how they correlate with stock price reactions, both in March 2020 as well as March 2023. Okay, so that's where we're going. So let me first show you the time series. What I have on the right-hand side is a change in reserves, correcting for reserves a year ago. On the left-hand side, I have either the change in log deposits or the change in log lines of credit at the aggregate level, at the banking system level, okay? And this is a long, big table, which typically you're not supposed to present in a big to a big audience. But focus on the right-hand side columns, which are in levels, not log changes. These are changes in levels. And what you see is $1 of reserves. That's column 5. $1 of reserves is correlated with $1 increase in deposits, okay? That seems, oh, well, yeah, they're financing additional reserves with deposits. Well, by the way, this is all correlations. This is not causation. I'll come to instrumentation in a bit. But the next column, column 6, a change in reserves of $1 results in financing by about $1.35 of demand deposits. Demand deposits are going up more than reserves. And on the other hand, time deposits are going down by about 24 cents per dollar. In other words, 22 cents per dollar. So I'm shifting from essentially a more stable liability structure, more time deposits, fewer demand deposits, to more demand deposits, fewer time deposits. And to boot, I'm writing claims on liquidity by writing lines of credit. That's the last column in this table. I can also do the same thing with uninsured demand deposits. And basically, this chart is saying much of the action is with uninsured demand deposits. So for every, these are in log changes, you can see that uninsured demand deposits, which is column 7, really are where the action is strongest when we add $1 of reserves. Now, what is the price of liquidity? Well, one measure of the price of liquidity in the markets is the effective Fed funds rate minus the interest on reserves. People sell reserves into the market at the effective Fed funds rate, and in a sense, the benchmark rate for that should be the interest on reserves that the banks get. And that difference, which is sometimes negative, is showing how plentiful reserves are there in the market. And you know, you can do the difference in that spread against log reserves and log deposits and log credit lines, or you can do the changes against changes. And changes against changes, many macro people would suggest is a better way of doing it because it deals with non-stationarity issues. We do it both ways. Let me just show you graphically. When you just run that difference between the effective Fed funds rates and interest on reserves, think of that as the price of liquidity on the y-axis, and on the x-axis you have the quantity of reserves. It's really a fuzzy chart with no real pattern when I just run it against reserves. But when I correct for the claims that have been issued on reserves, are those claims being priced? In this case, deposits and credit lines, what you see is essentially a straight line. So reserves are much more accurately priced by the effective Fed funds rate minus the interest on reserves, when I also note that there have been a lot of claims issued on reserves, and when I correct for that, the line becomes much clearer and straight. This is not us. This is Annette Wissing-Jorgensen and Lopez Salido. They look at deposits. You can look at demand deposits, uninsured deposits, basically the whole gamut, and it still shows up that the price of liquidity, more reserves will push down the price of liquidity. Liquidity is more plentifully available, but all these claims that have been issued on reserves will push up the price of liquidity. Okay, and that's what this chart is saying at the aggregate level. For example, credit lines. More credit lines you issue, more the price of liquidity goes up. More uninsured deposits you issue, more the price of liquidity goes up. And that's basically saying demand and supply. Basically, these are aspects of demand, even if they're not called upon today. They're potential demand. Those lines of credit, those demand deposits may be called upon, and therefore, banks want to make sure they have enough liquid assets to satisfy them, so there's more demand for reserves, and the price of reserves, price of liquidity goes up. So just to, at this point, sort of recap, the traditional view of reserves is they're a form of liquidity. The more the central bank puts out there, the more liquidity is put out. And therefore, the price of liquidity should go down. You've increased the supply of reserves. There's an exogenous demand for reserves. The price of liquidity should go down. Okay, so this is the traditional view. What we're saying is the demand for liquidity doesn't stay constant. Because of the way reserves are financed, the demand for liquidity goes up even as you issue more reserves. It's a moving target, in other words. You issue more reserves, the banking system issues more claims on reserves, and the demand for liquidity actually, we don't know where it is. Depends on the quantum of these liabilities, of these claims on liquidity written. So you really have to match the supply of reserves with the claims on reserves, which is the original claims, the original demand for liquidity, plus the new claims that are written. And that's what's going to determine the price of liquidity. And so if you don't account for this endogenous reaction of the commercial banking system, you're going to argue, well, we've got plenty of reserves. We operated with 100 billion before the global financial crisis. We operated with, maybe $1 trillion after the rounds of quantitative easing. So we can go back to that. No, you can't, because the banking system has used up all that and even more. And so going back is hard to do, okay? Here's another way of saying this, and this is, again, the last way of saying this in an aggregate way. What we run is a rolling regression of the effective Fed funds rate minus interest on reserves. This is 5-year rolling, against reserves and uninsured demand deposits. So I ran it in one regression there. Here I'm running it multiple times. And what you see on the left-hand side is essentially what effect the reserves have. And you see that the reserves become much more effective in bringing down the price when there are fewer of them, right? So in the period of quantitative tightening, that's where the red arrow on the left, and quantitative tightening more recently, in those periods, $1 of reserves has a big effect in reducing the price of liquidity, okay? So quantitative tightening is when things get hairy. What you see on the right-hand side is a similar effect of uninsured demand deposits in pushing up the price of liquidity when quantitative tightening happens. So, in other words, in normal times when there are plenty of reserves, nobody really cares as much whether you have reserves, demand deposits. It's when you pull back the reserves that the effect starts showing up. $1 of reserves becomes much more valuable. $1 of claims on reserves, that is, uninsured demand deposits, becomes much more costly. And that's why those prices, I think, are consistent with what we're saying. Illiquidity rises during the period of quantitative tightening because the system is much more levered, in a sense, to liquidity at that point. Okay, so next, I'm going to show you some parallel tests. Basically, the time series evidence says two things. One, demand deposits, time deposits correlated with the level of reserves and the change in reserves. And you have to, secondly, account for the claims on liquidity for the price of liquidity. But of course, a lot of stuff is happening at this time. And so what we really want to do is correct for all that and look in the cross-section of banks. Can we see similar effects on quantities and on prices? So are banks that exogenously get more reserves going to finance them more with uninsured demand deposits? And are banks that exogenously get more reserves likely to push down the price of time deposits because they think they want fewer long-term liabilities given they have such a quantity of reserves? I'm going to show you this. First, we need an instrument, and obviously we can spend all evening, all morning here debating the instrument we pick. But what we do is essentially argue that, well, the problem to some extent is reserves are exogenous for the banking system, but endogenous at any point for individual banks. For example, if I, as a bank, issue equity or sell assets, I'm going to get more reserves internally, but I've also changed my balance sheet, right? And similarly, if I'm a risk-averse bank, I might want higher time deposits and lower demand deposits, and I might also want more reserves to make my balance sheet more liquid. So all those may correlate, but it is because of my risk aversion that that's happening. So I in a sense, want to correct for all this and look at an exogenous component. So we do it in basically two ways. And let me just explain this verbally, and you can look at the draft, which is on the web. What we do is basically say the change in aggregate reserves is something the individual bank doesn't control. Also, the share it gets averaged over time is exogenous. It depends on what kind of bank it is. Money center banks get a greater share of reserves than their aggregate size because a lot more banks deal with them and rely on them as a depository of reserves. A small bank may have a lower share of reserves, of the incremental reserves, than its aggregate size because it's typically not in the flow of reserves. So we have two parts to the instrument. One is the change in aggregate reserves, and the second is the average sort of reserves that you had as a bank over the last 4 quarters. That's sort of the kind of instrument we have. One of our suggestions in one of the workshops was, look, reserves are not the only thing you need to worry about. The aggregate size of the Fed's balance sheet is also what you have to worry about. So we created two instruments. One is the change in aggregate reserves. The other is the change in the size of the Fed's balance sheet, both multiplied by what share your individual bank has of reserves. And it turns out both instruments sort of work individually, together, etc. The whole idea here is that your average share is a more exogenous thing than your momentary share. That could be moved up and down by your issuance, but your average share over time is more exogenous. As I said, again, we can debate this for a long time. However, when you put this in and you run the regression in the panel of the change in uninsured demand deposits against the change in instrumented reserves, I'm showing you just one part of the second stage to focus. We have time-fixed effects, clustering, some controls, and it's an instrumental variable estimation. First, on the overall period, whether you look at the periods of QE, the first three columns all show it's all strong and positive. More reserves means you have financed it with more uninsured demand deposits. The only place where it breaks down is in that interim period when QE stopped. And there we basically find a negative effect, but it's not statistically significant. In other words, it just becomes really noisy. And that's suggesting during that period, what I showed you on the aggregate graphs, you don't see the shrinkage even as reserves are shrinking. That's what's going on. You don't see a very definite reduction in uninsured demand deposits at that point. If it did happen, we would be very comfortable. The central bank expands its balance sheet, great. It contracts its balance sheet. The commercial banks contract their balance sheet. No problem. Let's not worry. It's because they don't contract their balance sheet while the central bank is contracting reserves that the system becomes more and more highly levered on the available reserves. And that creates the problems that we see. The second point I want to make is there's an active shortening of the maturities of deposits. Look at the CD rates for banks, and you find that banks with more reserves are actively pushing down the spread that they offer on certificates of deposit, of time deposit. Again, you will see this sort of works for the overall period across deposits. The only funny deposit is the 12-month deposit because different banks, some interpret it as you can break it with very little breakage fee. Others will charge a high breakage fee. I think that makes the 12-month deposit a little less clear, but you can see even there, the coefficient is negative. More reserves means I'm shrinking that spread. And across the maturities of deposits, that seems to work. Again, when you look at that specific period of when quantitative easing stops and hasn't resumed again till 2019 September, that period, you don't see much of an effect. Very noisy. Okay. So, last point on credit lines. Credit lines also, you would expect credit lines to non-investment grade firms being the most sort of, risky credit line that you could sell as a bank. And you can see more reserves you have, more of those you originate. Again, it's that post-QE 3 before you start QE again, where you don't see much of an effect, positive but not significant. So, what we're basically saying is QE is creating the conditions for issuing demandable claims, which comes to roost during the period of quantitative tightening, resulting in financial fragility. So, why does financial fragility happen? Why do we see those things happen in September 2019 and again before as the pandemic hits? Basically, we're arguing there's a ratcheting up of claims on liquidity, and the big surprising thing is why they don't shrink their claims on liquidity when the Fed sort of essentially is selling securities back to the system. Why don't bank balance sheets shrink? Why do they seem to be doing the kind of asset swap that we showed in that first version? And it seems, one way of explaining this is, look, what are they swapping into? They're swapping into treasuries. They are the second most liquid asset on the planet. The most liquid is reserves. Treasuries are the second most liquid asset. So maybe banks think, when push comes to shove, we will have the claims. We can, issue. We can do repos with these. These are eligible securities for repos. We can do repos with these and get the reserves that we want when we need them. But you're one step away from final settlement liquidity, that is reserves. And in an episode of Dash for Cash, when everybody's running for what is cash, which is reserves or actual, physical currency, at that point, basically you have less. So it's like a game of musical chairs where they've taken out 3 or 4 chairs rather than taken out 1 chair. And so, yeah, while the music's playing, you're dancing, you're going around, no problem. But if everybody runs for liquidity, we're all running at the same time. There's less liquidity to satisfy us. So even if this is what is happening, it does mean that, there are fewer reserves to satisfy everybody if push comes to shove. And so what we do is we talk about a measure of liquidity risk, which is credit lines plus uninsured demand deposits divided by the sum of reserves and eligible assets to see if this is what's going on. Does everybody think we have a seat because we've got these eligible assets? But of course, when the time comes, they will not have that seat. But it turns out it's worse than this. It turns out even when you correct for the eligible assets, they're going out on a limb. They have more claims than the sum of eligible assets. And this is one example of that. First, what you see, and this is just plainly putting up the size of uninsured demand deposits across three kinds of banks. The big money center banks, that's in blue, 250 billion in assets and above. The red ones, which is the mid-sized banks, and the small ones below 50 billion is green. And what you see, interestingly, is all three are ratcheting up uninsured demand deposits, but the big effect is in the small banks. The small banks are ratcheting up even more. And of course, recently they've come down as interest rates have moved up and they've seen deposits leave. But the small banks are relatively the biggest outliers in terms of issuing uninsured demand deposits. If you look at the chart, the table on the left-hand side, you see the small banks have increased their uninsured demand deposits from 10% of liabilities to 30%. They've tripled the size of uninsured demand deposits. If this is not a system taking more risk, I don't know what is. Okay, so that's one. Second, let me divide these by the eligible assets and reserves, or just by reserves themselves. You get the same answer. When you divide these, what you see is going up to September 2019, from the period that quantitative easing stops, you find these claims on liquidity. For example, the dotted line is uninsured demand deposits. They're going up relative to the available reserves, divided by also the eligible assets, and you'll get something similar. In other words, we are ratcheting up the claims on liquidity relative to the reserves that are available to satisfy them. And the last point is, let's look at this across banks. So I have uninsured demand deposits divided by reserves plus eligible assets. And you can see the small banks have actually overtaken the mid-sized banks, in fact, gone above the big banks at one point before things started shrinking. In other words, the small banks are taking much more liquidity risk. Now, you could argue, well, they're happy because somehow they will get those reserves from the big banks when push comes to shove. But only if the big banks are willing to lend. If the big banks aren't willing, they're holding liquidity themselves, you've got that problem when this happens. So let me, before I end, give you more evidence on who's doing this. What we find is the small banks are basically the ones ratcheting up liquidity risk. Maybe it is because they're not the ones subject to liquidity coverage ratios, perhaps. What you also see is the ones that basically do more of this get more return on equity. They're using their balance sheets more efficiently, but that means taking more risk. Their return on equity is higher. They also tend to be lower capitalized banks, which you would think would be the ones taking more risk. So they are showing higher returns. They are undercapitalized, and they are the ones that get hit when liquidity dries up. So what you see on the x-axis here is the claims on liquidity divided by eligible assets plus reserves. On the y-axis, you see return on equity, and you see it's a pretty straight line. The banks that are taking this risk are earning higher returns on equity. this is just a regression showing you something similar. What you also see in this regression is it's the below median equity banks that are doing more of this. The undercapitalized banks, so to speak, are doing more of this. And finally, I want to show you that in this period, as a result of all this, what happens is within the system, where the liquidity is and where the claims are gets more skewed. There are more claims in some part of the system relative to the reserves that are available, and that subjects the system to more shocks. So it's not only that the system has less liquidity on average, but the liquidity is not where it should be with the guys who have written relatively more claims. So this is a skew that I want to show you that, as you move from quantitative easing to the post-QE period to quantitative tightening, you see more banks moving to the right, that is having more claims on liquidity relative to reserves and eligible assets, and especially many more banks in the tail, that is at numbers which are more than 6. So people are writing more claims, and these are a fringe of banks. And that is saying the system within itself is also getting more skewed, even as the system as a whole has fewer reserves. And finally, what I want to show you is what happens when the COVID shock hits. March 2020, all hell breaks loose. What happens to the share prices of these banks? And what you find is basically look at the banks that have low claims on liquidity versus the banks that have high claims on liquidity. Look at their relative share prices, and you see the banks with high claims on liquidity suffer a much a higher fall in share prices. That's basically what this graph is showing you post March 2020. You don't see much of an effect pre-March 2020. That's why it's close to zero. And then you see a bigger effect post-March 2020. That's whether your claims on liquidity matter. This also shows you drawdowns, that the guys who have essentially more stretched liquidity are the ones where firms draw down more of their credit lines. That seems obvious, right? If I know my guy will not fulfill my demand for a credit line because he's stretched on liquidity, let me draw it down before so that I have some liquidity, especially when I'm faced with something like the pandemic, where I have no idea how much liquidity I'll need. So as a firm, I draw it down before, and you see that out here, they're drawing down more. So this is basically a table showing you pretty much the same thing. Guys who've written more claims on liquidity tend to have a greater negative stock price reaction once the pandemic sort of becomes fully internalized in the system. That is not before January typically, but as you go into the period. Let me finally end with the recent banking stress. What the previous period of quantitative tightening did not have was a significant rise in interest rates. What happened in 2017, 18, 19 was interest rates went mildly up, but what was really happening was the Fed's balance sheet was shrinking. This time around, you had both. Starting in March 2022, you had interest rates going up, and you had the Fed's balance sheet tightening, and that would suggest you had the twin effects. For banks that had a lot in long-term securities and long-term loans, there was a solvency effect because the higher interest rates would have reduced the value of their balance sheet. And at the same time, there's a liquidity effect because there was less liquidity available. And so essentially, what we had was much more stress. Now, this stress was obviously augmented by the fact that during the period of quantitative easing, when the pandemic hit, more and more banks had more and more uninsured demand deposits. So this is, what you see from 2019, September, into when quantitative tightening started, a substantial increase in the uninsured demand deposits within the system. And basically, uninsured demand deposits to total deposits goes up from about 47% to 53 or 54% of liabilities within the system, and then it starts shrinking when quantitative tightening happens. This is, again, a huge stress shock for the system. What we show here is that when you look at the change in uninsured deposits, it's not just because of the stimulus. It is happening throughout the period. You're seeing an increase in uninsured deposits, and insured deposits are different. Insured deposits, when you take out the stimulus quarters, you don't see much of an effect as a result of quantitative easing during the pandemic. But the uninsured deposits, regardless of whether you put the stimulus quarters or not, it is going up. So that is suggesting that much of this effect that we're showing is because of uninsured deposits. And again, in March 2023, you see the effects on excess returns. Uninsured deposits, the banks that have more uninsured deposits, that's column 3, tend to have lower stock price returns, and it's especially pronounced with uninsured demand deposits. Then finally, what I want to show you is bank stock returns during the SVB crisis. Big effect, but largely among small banks. Small banks tend to have a big negative stock price reaction. Large banks may even have a positive reaction, and we know that. That's the flight to safety. But also, those are the banks that were fairly well bolstered by reserves relative to uninsured demand deposits, given the historical past. They didn't go out on a limb. The small banks that went out on a limb, and they got hit much harder, especially the ones that had more claims on liquidity relative to reserves. Okay, let me end now with policy implications. Basically, is there a problem with the Fed providing this liquidity? And the answer is, the problem comes when you withdraw it. The system gets used to the liquidity, and so when you withdraw it, the withdrawal pangs start. It's like any drug. You give it, and the system gets addicted. So what you then have to do is come back with more of the drug. And the question is, will you ever be able to get out? In Hindu philosophy, we call it the Chakravyuh, the whirlpool. Once you get in, it's really hard to get out. So the problem, of course, if you do this repeatedly, is the market underprices liquidity and takes more and more liquidity bets when the liquidity is available, which then makes it hard to withdraw the liquidity as the Fed without creating problems. So it's easy for the Fed to get in, hard to get out. You might say, well, the Fed can expand its balance sheet endlessly. But think about what we saw happening in the UK with LDI. The withdrawal of liquidity, along with other factors, created tremendous tension in the markets. The Bank of England went back, but it was going back at a time it was trying to tighten monetary policy in order to bring inflation down. So you had, on the one hand, you're expanding your balance sheet, which is a kind of monetary accommodation, at the same time raising interest rates, which is withdrawing monetary accommodation. Your twin actions are contradictory, which is why the Bank of England said repeatedly, this is really, really short term. It turned out to be enough, but will it always turn out to be enough? Will you need to come back in a big way if quantitative tightening becomes a problem? And of course, there are accidents because there are places the Fed can't reach. There's also the concern if the Fed has to maintain a really large balance sheet, you're financing the government all the time with such a big balance sheet. Is that a reasonable thing to do? Do you get fiscal dominance? And of course, as I said, this could interfere with the monetary function. So is financial stability at conflict with monetary policy? Is it an accident waiting to happen? Also, one of the things that seems to me particularly perturbing is why we are not more perturbed at the level of Fed intervention in March 2023. Yes, we all say needed to stabilize the system. Fed did a good job. The system is stabilized. But we just insured effectively all uninsured demand deposits. At some point, maybe 20 years ago, we'd have been up in arms saying, you're intervening in the market system. And now it's become routine. We don't even bat an eyelid when this happens at such a large scale. And the question is, have we essentially created a system where the system has become dependent on the central bank to come to its rescue at every point, and the central bank does come to its rescue, so much so that the public no longer cares. And as you know, there's talk now of insuring all uninsured demand deposits all the time, in which case, who prices risk in the system? If it's the Fed that's going to be pricing risk, well, it's not the best entity to be pricing. So what do we suggest? Well, let's get out of this first. Let's do QT. I would argue one reason it hasn't had more effect is right now the reserves are being withdrawn by the money markets. I said banks only could hold reserves. Well, in the U.S. today, money market funds can also hold reserves. So by withdrawing reserves, we're first withdrawing them from the money markets, less of a problem. Once you start withdrawing reserves from the banking system, perhaps it could get tighter more quickly. And so we have some time, but there is a question of when it starts biting and what the optimal size of the Fed balance sheet is. And I think there's a ratchet effect going on. That balance sheet size keeps getting bigger and bigger. So this is something to think about. Of course, some people think there's no problem with a really large Fed balance sheet. And, in the paper, we talk about some reasons for that. Certainly, even if you don't care about anything, the nexus between the public sector balance sheet and the private sector balance sheet that is emerging from all this is something to be worried about, because those nexuses means things are really underpriced, and it could also distort activity. Let me stop there. Happy to take questions. Thanks for being so patient.